Welcome to this explainer on Patrick Industries Q2 2026 earnings. Today, we're unpacking a truly fascinating story of corporate resilience, strategic growth, and honestly, what happens when a company figures out exactly how to hedge its bets. If you follow the manufacturing and component supply space, you already know it's been a tough, turbulent year. We're talking shifting consumer spending, supply chain headaches, the whole shebang. But Patrick Industries? Well, they just delivered an absolute masterclass in navigating that turbulence. Let's get into it.
So let's dive right into this core paradox. How on earth does a component supplier boost their bottom line so significantly when their primary revenue-generating end market takes a massive hit? I mean, it sounds like a mathematical impossibility, right? You'd naturally expect shrinking demand to drag profits right down the drain with it. But this isn't a typo on a balance sheet. It's the direct result of a highly calculated business model that we are going to decode right now.
To solve this mystery over the next few minutes, this explainer will map out the RV downturn, look closely at the Q2 numbers, explore the company's diversification strategy, check their cash flow, and finally, look ahead to a massive upcoming merger.
All right, part 1, defying the RV downturn.
You see, the recreational vehicle market has historically been Patrick's bread and butter, making up nearly 40% of their revenue. But in Q2 of 2026, wholesale RV shipments dropped 16%. Consumers really tapped the brakes hard amidst a tough discretionary environment. Higher interest rates and inflation naturally cooled the demand for those big-ticket travel items. But here is the kicker. Patrick used other sectors like marine as financial shock absorbers. By catching a wave in the boating sector, they were able to buoy their entire operation and totally defy the gravity of that RV slump.
Moving right along to part 2, Q2 2026 by the numbers.
So, despite that massive headwind in the RV space, their top-line net sales held incredibly steady at $1.04 billion. That is down less than 1% from the prior year. Just think about that for a second. When your biggest market is down double digits, just holding the line on your top revenue figure, that's a major victory. It proves their safety net is working exactly as designed, completely shielding the broader company from localized sector volatility.
Now, while revenue stayed flat, their diluted earnings per share jumped a staggering 33% to $1.28. This isn't just about selling things, right? It's about selling them much, much more efficiently. They capitalized on cost controls and better pricing power, meaning literally every dollar coming in worked harder for them. This incredible margin expansion drove overall net income up 34% to $43 million for the quarter. They didn't just survive the RV downturn, no. They optimized their operations and became dramatically more profitable right in the middle of it.
Which brings us to part 3, the power of diversification.
The actual mechanics of their strategy are brilliant in their simplicity. Yes, the 15% revenue drop in RVs is a glaring headwind, but it was successfully countered by a 22% surge in marine and a massive 28% jump in power sports. They even saw steady stability in housing. When one leg of the stool wobbled, the other 3 legs grew stronger to support the weight, essentially proving that strategic cross-market expansion is the ultimate defense against an economic downturn.
But hey, it's not just about selling into different markets, it's about selling more into those markets. To really grasp this growth, we have to understand a vital industry metric called content per unit. This simply measures the total dollar value of Patrick's products that are squeezed into each individual vehicle, home, or boat. It means they aren't just selling the basic wood paneling anymore. They're selling the paneling, the premium cabinets, the custom wiring, the high-end hinges, all of it going into a single completed unit.
And this reveals their secret weapon. Even though they sold fewer RVs overall, Patrick actually grew their content per RV unit by 7% to over $5,300. That means every single RV rolling off the assembly line has more of Patrick's components inside it than it did last year. Meanwhile, they simultaneously exploded their marine content per unit by 22%, nearing $4,900 per boat. They are rapidly expanding their footprint inside the very products they supply. They're increasing their revenue per customer even when the actual customer volume shrinks.
We're seeing this exact same dynamic play out in the power sports division too. The sector thrived not just from a high volume of utility units being sold, but from a major shift in consumer behavior toward premium upgrades. We're talking about high margin attachments here, things like custom cab enclosures and premium audio systems. They aren't just selling basic chassis parts, they're capturing those high-dollar premium upgrades that today's consumers are absolutely demanding when they hit the trails.
Patrick's president, Jeff Rodino, really hit the nail on the head regarding this exact strategy. He notes that by partnering directly with original equipment manufacturers, the folks actually building these vehicles, they focus on product differentiation and efficiency. This allows Patrick to deliver way more value, totally regardless of broader retail demand patterns. They aren't just a vendor dropping off parts at the back door. They're a problem-solving partner, engineering solutions that make the end product better and much easier to build.
Let's shift gears to part 4, cash flow and capital.
So management felt incredibly confident in their balancing act this quarter. Honestly, so confident that they returned a staggering $106 million to shareholders. They allocated $15 million to regular quarterly dividends, but a hefty $91 million went straight to share repurchases, buying back nearly 1 million shares of their own stock. Allocating that much cash to buybacks rather than just hoarding it for a rainy day is a massive vote of confidence from the executive team in the intrinsic long-term value of their company.
And to be clear, they aren't just spending wildly. They backed up these shareholder returns with a rock-solid financial foundation. Over the trailing 12 months, they've generated $128 million in free cash flow. They've maintained a healthy net leverage ratio of 3.0x, which is a highly manageable debt load that gives them incredible operational flexibility, especially in a high-interest rate environment. Plus, they're sitting on $691 million in available liquidity. This isn't just a company surviving a downturn, guys. This is a company with a formidable war chest.
And that brings us to our final section, looking ahead to the LCI merger.
Announced just as the quarter closed, Patrick signed a definitive agreement to combine with LCI Industries in a massive all-stock merger. Make no mistake, this isn't just a standard acquisition. This is a truly transformative combination. By merging two titans of the industry, they are set to significantly expand their market footprint, creating an absolute powerhouse in the outdoor enthusiast and housing supply chains. The synergies and scale here are just massive.
CEO Andy Nemeth made their position very clear, stating that they are absolutely not waiting around for a market rebound. Instead, they are proactively using this merger and their highly successful diversified model to build an agile platform for long-term profitable growth. It's a bold stance for sure. They are actively dictating their own future and aggressively expanding their reach, rather than passively letting macroeconomic headwinds dictate it for them.
So as we wrap up this explainer, I want to leave you with this thought to ponder. We've just seen how Patrick's strategic balancing act yielded record resilience and incredible profitability entirely on its own. If this is what they can do as a standalone entity during a really volatile market, what new industry standard will this upcoming mega merger with LCI create? The supply chain landscape is shifting rapidly, and it looks like Patrick Industries is positioning itself right at the epicenter of that change. Thanks for joining me for this explainer, and I can't wait to dive into the next topic with you soon.